My name is Rich Morrison, and my role with NAU Country is to work with work with your producers to provide market information. And we all realize that certainly there's a connection between marketing and crop insurance. Crop insurance utilizes market prices in determining guarantees. And so part of what we want to do is not only help the producer to be able to select the right policy, but we also want to help them to be able to do something with that policy, do something with their bushel guarantee in order to market when they have the opportunity. And so thank you for joining this morning to this fourth of the fall series of the NAU Country Connection webinars. My beginnings were in the grain business back in 1988, and I spent about a dozen years in the grain business prior to moving over to the risk management side. But this was a question that we asked when I was in the grain industry. We asked a group of producers in a focus group that what was important to them, what could we do to help add value to what we were already doing in the grain side. And overwhelmingly, producers said that grain marketing was the number one thing that they needed and were willing to pay for. And so that really changed the focus of our grain elevator business, and trying to work more closely with our farmers in helping them market their grain. So we're all familiar with this equation: yield times price equals revenue. We in the crop insurance business have the opportunity to work with producers on two of these. We can help them to ensure a minimum yield on their production. We can help them ensure a minimum revenue on their farm. But the one thing we can't physically do is help them on the price. They still have to make those pricing decisions on their own. And so that's where my role with NAU Country steps in to try to not tell them when's the right time to be selling. We don't want to do that, but we'd also want to, can and direct them to make good decisions. When's a good time maybe to consider doing something, and throw out some ideas. And we can also tell them maybe when's a bad time. Seasonally, when are the funds all short the market, things like that maybe is not, maybe indicates that now is not a good time to be sellers. So why is marketing important? Look at the range of prices over the in last year's crop year. These were the 2019 futures prices, and it's amazing to see that the spread from the high to the low. If producers were selling these higher ends or close to the highs in the futures price for 19, they were making some pretty good money. If you were able to sell wheat in the 6s, cotton at 80 cents, soybeans in the upper 9s, corn over $4, had opportunities to make quite a bit of money on the farm. If producers were selling at these lower levels, these are now back below the PLC prices. So, and now you're relying on the government payments just to try to scrape by and break even. So a huge difference there. Look in 2020, similar situation in 2020. We've had over $1 trading range in corn, soybeans, over $2 now with the recent run up. We've had a big range in wheat. We've had a big spread again this year in cotton prices. So we've gone from levels that were losing money to levels where producers could make some pretty decent money. So again, we're not trying to tell them today is the day. We're not trying to help them pick the high. We're trying to keep them out of trouble. We're trying to give them ideas that they could utilize when the markets provide opportunities. So this is another formula that you're probably well aware of. Futures plus basis equals cash price. Producers are typically in a cash price world. That's what they're looking at. They're looking at what they can get when they deliver the grain to an elevator or elsewhere. We work with futures prices. We're working with the Chicago Board of Trade, the New York Exchange on cotton. Those are the prices that we utilize for our crop insurance policies. So in the middle of that is basis, and we all talk to producers off and on about basis. Some good comments, some bad, but nonetheless, basis is what the middle ground is, and what ultimately brings everything back to a cash price. So some quick definitions and just a quick overview on markets before we kind of talk about what we can do. Futures prices are standardized legal agreements to buy or sell a specific amount of a commodity at a predetermined price at a specific time in the future between two parties that don't know each other. So on the Chicago Board of Trade, for example, you'll have one person that wants to sell corn today at $3.70. Somebody else may want to buy it at $3.70. There are specific rules involved there. The quality, it has to be number 2 yellow corn, has to be at a certain price, a certain time. They're selling December futures, for example. So these are all done with people, but for a future period of time. So you could lock in a value of corn in July, in next September, next December. The futures market allows us to be able to do that and provides a lot of liquidity for anybody that wants to trade. Now, the cash price is, again, what the farmer lives with. He is looking at the amount paid for a commodity, specific quality, taken to a certain location at a specific time. So number 2 yellow corn delivered to the Mississippi River Terminal X during the month of October. That's what he's looking at. Ultimately, that's where he gets paid. Now, the basis is the difference, and we're familiar with that. I hear folks in South Carolina tell me that our crop insurance policies ought to be utilizing a higher basis or a higher spread. I've got folks in North Dakota telling me that it needs to be using theirs. But futures prices allow everybody to be able to use the same policy. The basis then is what changes the value to the cash price. And that's the difference in the futures and cash prices. And some of the things that impact basis are regional supply and demand. You have a lot of demand in Texas where we're feeding a lot of corn. You don't have as much demand in the upper Midwest, and so that impacts basis. Transportation costs to get corn from the Dakotas to Texas. Storage cost, what's it, at harvest time, if we're going to be taxing the elevator storage, they're going to widen the basis level to reflect that. Interest and insurance, a couple of other smaller factors, but nonetheless do have some impact on price. And I thought this was a really cool map that I had found from DTN last year, reflecting some of the change in basis levels across the Midwest. And you remember back in the fall of, or back in, 2019, I guess, we had a lot of prevented plant out east in Indiana and Ohio. We had some pretty big crops that year in the upper Midwest, and it reflects here in these basis levels for mid-December delivery. We had ethanol plants in Ohio that were paying 30 cents above, 35 cents above the Chicago Board of Trade for corn, trying to find corn. You had elevators in North Dakota that had too much of it, and so therefore were not paying up at all. In fact, discouraging delivery at that point. And so you can pretty obvious that we probably had a lot of rail grain that year moving from the upper Midwest across the Corn Belt to the east to try to meet that demand. And so that's the job of the basis, to reflect those changes and the differences. So some marketing tools, moving beyond the definitions, what do we have that we can help producers with? Well, we're all aware of cash grain contracts, futures and options we'll talk about, and then revenue insurance is a marketing tool, and I'll explain how that works here in just a few minutes. But first, just a quick overview of some of the cash grain contracts. Some of the things that producers use. A spot sale is basically just delivering something that day to the elevator and getting paid for it at the day's price. A forward contract is locking in the cash price for a future delivery. Say for next January delivery, I'm going to sell my corn today at $3.50. A basis contract is locking in the difference, but not locking in the entire price. So I'm just locking in the spread between the futures market and the cash price. Basically, if I look back at that basis map a minute ago in Ohio, maybe I had corn to deliver. I'm going to lock it in at 30 cents over the Board of Trade. I think the Board of Trade price might go higher, but I'm not willing to sell that yet, but I am willing to lock in the basis. So that's if I think futures price could go higher later, I can just set the basis today, wait and lock in the futures portion of my price later. Delayed price or price later means I can deliver the grain to the elevator, not get paid, not lock in a price yet. I'm bullish. I think the price can go up, but I need to deliver the grain. A hedge to arrive or a futures only contract is basically like a futures hedge, only done through the elevator. Usually you can trade futures, say through the Chicago Board of Trade, for 1 to 2 cents a bushel. If I do this through the elevator, a lot of times they'll charge me maybe 5 to 10 cents a bushel. But the difference is if I trade futures or options on the board of trade, I have something called margin calls that I have to maintain. If I do this through the grain elevator, usually they'll cover that. A minimum price contract usually contains an option or an over-the-counter option, something like that. But minimum price contracts allow a producer to lock in a floor price but have opportunity to make money if the market goes up later. And then there's many more exotic contracts. There's contracts that contain more than one option. There's contracts that say if I deliver grain today, I'll get X price, but if the market goes above a certain level, then I owe 2 times the amount of bushels. So there's a lot of different things that elevators have gotten creative with over the years, and to be able to attract business. But I asked this question: which price parts are set with each contract and why? I think we kind of explained some of that. Some have basis, some have cash, some have futures. So there's a little bit of everything when we're doing this. So a lot of different opportunities that a producer has in marketing their grain. The market year average price, we're all familiar with that. If you're familiar with PLC and ARC programs, those utilize the average U.S. cash price for the entire marketing year. USDA has a formula that they try to keep track of the percentage of grain that they believe is sold each month. They come up with the average price that they think around the United States during that month, and then they keep track of that weighted average throughout the year. And then when we get to the end of the marketing year, that MYA price is what's utilized to determine PLC and ARC payments. So some of you, if you have watched my webinar, read the emails, you might have seen this this chart in there. And this is what I use to keep track of the market year average prices. I've got the PLC reference prices on the left-hand side of the page. Those are the prices that if the market year average price ends up under, then we're going to be able to trigger PLC payments. On the right-hand side in the red, I've got the benchmark prices for the ARC program. And there's a formula that goes into ARC. We take that price times the county's 5-year Olympic average yield times 86% to come up with the ARC trigger. At the end of the year, we take the final county yield times the market year average price to determine the county revenue. And then if there's a loss in revenue, ARC is going to pay money. But the ones in the gold boxes in the middle are the prices that we utilize. Those are the market year average cash prices. For 19 and 20 marketing year, that year ended the 1st of September. So these ought to be the final numbers that are used to determine the PLC payments and ARC payments for the 19 crop year. And as of today, assuming these are all final, these ones in gold that are highlighted in gold would be triggering a PLC payment. So corn right now would be triggering a dime payment for the PLC program. Wheat would be 92 cents, etc. Go down the line, cotton about a little over 6 cents, sorghum 65 cents. For next year, the year that just started September 1, this second gold column is USDA's current estimate on prices. We've got a long way to go to the end of the year, but as of the September crop report, these are the latest estimates that would be used for PLC and ARC payments. And again, the ones that I've highlighted in gold would be low enough to be triggering a PLC payment for the 2021 marketing year. This is very important, I think, for us as insurance agents to be able to share this information with our producers. Otherwise, where else are they going to get it? Are they going to go dig it up on the internet themselves? Probably not. This is something that I keep track of, and I continue to keep in our newsletters each month. And so if you're the person to be able to provide that information to the producer, it's probably, you know, a very wanted service. One thing I would note on here, soybeans are the crop right now that does not have a price low enough to trigger a PLC payment, both for the 19 and the 20 marketing years. So moving on, futures and options. That's the next level of marketing. Rather than doing anything with a cash price, we can also producers can use futures and options. Why would they want to do that? You get a lot more flexibility. If I trade or if I use the futures market or the options market to hedge, then I'm not locked into delivering my grain to a particular elevator. At the time it comes to deliver the grain, then I have a lot of choices. If I sell my grain forward sell in the cash market at a particular elevator, I have to deliver to that location. And maybe that's not the best bid come time to deliver. I have the potential to gain on the basis, and we showed you that basis map earlier. But it's kind of nice to have that flexibility that if one ethanol plant or one feed mill decides that it needs corn and they raise their basis, that I can deliver to that elevator instead. The cost of doing that versus similar cash contracts. I mentioned earlier that if I trade through a grain elevator without setting the basis, a lot of times they might charge you 5 to 10 cents. And if you trade through your broker, might cost you a penny to 2 cents. And then the last comment, I made this earlier, but we utilize futures prices for crop insurance. Those are the ones that we watch. Those are the ones that I predominantly talk about in my communications. And this is a snapshot of my quote screen. Got a lot of symbols on here. You're probably not familiar with all of them, most of you, but the C's are corn. So Z means the electronic trade. And so this is the electronic corn trade as of yesterday when I updated the chart. It was up a penny. The last trade on December corn was 370 3/4. We got the high and the low, and then the time that the last tick took place. Soybeans, I've got soybean meal as the MZ, BO is soybean oil, Canadian rapeseed is the RS. I've got cotton, I've got rice, I've got all my wheats. On the right-hand side, I've got live cattle, feeder cattle, hogs, and dairy. And then down at the bottom, I've got some of the macro markets like the dollar index, crude oil, gold, and the stock market. So I watch all of these throughout the day. This gives me a good overview of what's going on. I kind of got this in the background of my screen when I'm sitting at my desk. But and I can kind of see if something wild is taking place, like the stock market rallies 500 points, then I know there's probably going to be an impact on some of the other markets as well at that time. Futures prices. So when you're trading futures, there's two sides you can take to the market, the sell side or the buy side. If you're a seller in futures, you're short the market, which the people that would use short hedges would be producers that are expecting to raise a crop, or you've already raised the crop and it's in the bin. Those are really the two people that would trade in our world that would trade futures. Besides that, of course, you have speculators and some others as well. But from a farmer standpoint, we have people that forward sell, lock in a forward price, and then we have others that might lock in a price that's for something that's already raised, but they don't want to deliver maybe until a future time. People that would buy the market would be a farmer that may have sold his grain out of the field, but he's still bullish the market or becomes bullish. And so he wants to re-own those on paper, we call it, or basically buy commodity futures. So he takes advantage maybe of a cash market, or maybe he doesn't have any bins to store it in. He can sell off out of the field in the fall, but then re-own it basically on paper. Or livestock producers. If you're a cattle farmer and you're going to be a buyer of corn feed throughout the year, you may want to go out to next year and buy May futures and July futures as a hedge, just in case the corn market goes up later on in the year, and you might have to pay more for your cash corn at a later time. So here's a picture of my futures chart. This is November soybeans. This was yesterday afternoon, or yesterday morning, I guess. And so you can see what's happened in November soybean futures over the last 9 months. It's been a wild ride, to say the least. The black lines on this chart are considered to be a day. And so if you pick out just one particular black line, the little line to the left of that line was where the market opened that day on November futures. And the little line to the right-hand side is where the market closed that given day. And then the line represents the range from the low trade to the high trade during each of these days. And so you can kind of tell what the range has been. It's been a fairly wide trading range that we've had a lot of these days as the markets have made new highs. A few other things I'll point out here as I guess I'll toggle forward first. I've got a lot of lines on this chart, and one set of lines are these colored lines that are on the chart. Those are moving average lines. Those are basically simple moving averages. And you can see the red, the blue, the green. I'll go back here real quick. The red line is the running 9-day moving average on November soybean futures. So it's a short-term moving average. It's a quick moving average, so it's changes fairly erratically sometimes, and you can see that it's got the most movement because it's showing the quickest turn in what the markets are doing. And if you read the market report last night or heard comments this morning, we were talking about this 9-day moving average in November soybeans being a very, very key support right now for this contract. And you can see that we've, for the most part, been above the 9-day moving average since early August. If we were to break below that and close below it, it might trigger some selling in the market. So that's something we're watching real closely right now. The blue line is the 20-day moving average. The green is the 40. The gold is the 50. The purple is the 100. And the light blue is the 200-day moving average. And it's kind of interesting. We've got them all now finally turned higher, which I think when that started to happen here back in early September, triggered a lot of new speculative buying in the soybean market and continued to run this market maybe even higher than it should have, but nonetheless, it's taken us to some new high levels. Some other lines down at the bottom of the chart, I'll go back here in a second. The relative strength index is the green line, and the RSI is basically a measure of the volume of trade in an up or down market. And I compare the RSI measurement to like a wooden roller coaster. That when a wood roller coaster, we've all been on a coaster, and when you're at the bottom and you're starting up a hill, you're going fast. You've got a lot of momentum from the last swing in the price, or the last swing in the coaster coming down. You've got a lot of momentum as you start up the hill. But what happens as you get towards the top of the hill, you start to run out of momentum. You start to slow down. And that's what happens in a bull market, for example. We see a lot of people wanting to buy early and through the middle of that run in the market. But as you get close to the top, the volume of trade starts to slow down. We still might rally, but we just don't see as much trading take place. And ultimately, you run into a vacuum, it stops, and then the market turns and goes the other direction. It's kind of what happened on Monday. Finally, we ran out of fresh buyers, and the market turned over. The stochastics lines at the bottom are very similar as well. They kind of measure something very similar, but just a different methodology. But basically, these two sets of lines do the same thing. And so if I look back at my chart once again, I've got the RSI, this green line at the bottom of the chart. I've got the red and the blue lines, or the stochastics, slow stochastics lines. And some of the indicators, some of the way we use this at times is the RSI. When the RSI hits 70, this red dotted line, that's considered to be a buy signal, or excuse me, a sell signal. It means the market's overbought. It's probably due for a correction to the downside. Go back to the beginning of January when the RSI got up into the low 70s. That's right about the time the market peaked out. We went down. The RSI, when it gets below 30, that's considered to be an oversold market, this light blue line, and that's usually a time where if you're a speculator, you might consider buying the market. We had quite a bit of period there, especially when the COVID outbreak hit in the middle of March, where the RSI went well below 30, went even below 20 in a period of time. It was way oversold, probably due for some correction back to the upside. But one thing we've been talking about, I've written about over the last 3 weeks, is that this market's been toppy. It's been overbought. And we've had the RSI even get up into the 80s prior to this recent connection. But we had a lot of speculative buying come into the bean market as China was buying beans, as we took the crop size down a little bit in the last crop report. A lot of reasons maybe that this bean market extended. Now we're kind of backing off a little bit. Same with the stochastics lines. There's a saying that when the red line crosses the blue line, it's time to sell or buy, depending on which direction it's going. Back here at the beginning of August, when the short-term stochastic line crossed the midterm, that was probably a buy signal from some people. And we saw the market turn at that point in time. You can look back to some of these more methodical markets back in there at the end of December, at the end of January. We saw a lot of times where the stochastics turned. This latest run has been really driven more by speculative buying, and it's kind of held the market a little higher, but it looks like this market might be ready to turn as well. So these are all things that I try to incorporate into some of the information that I put out to our producers. A lot of people are fully technical traders. That's all they look at is the chart. They look at nothing more. They don't care what the supply and demand fundamentals are. I tend to be probably about 70% fundamental and about 30% technical. I think that ultimately the fundamentals will will reign when it comes to what markets should do. However, once the market starts to move, I do believe that the technicals do have a big impact on how far they go. And so I think you need to be cognizant of both, not only the balance sheet and how many bushels of which crop do we have carried over into next year, how big is the crop going to be, but then also be looking at these technical indicators to have a good idea of when the market could be starting to get a little bit toppy. And I mentioned the funds or the managed funds, the speculator position. I think that's an important part of what we focus on, because generally when we've got a lot of speculators, or they say, you know, when everybody's on one side of the boat, you probably don't want to be on that side of the boat. And so that's what we can keep track of with some of this speculative trade. And Karen Braun with Reuters, we've got others, analysts. I get a copy of this report every Friday that comes out from the CFTC, and they tell us what these managed funds as a group did with their net position in each of these crop markets during the past 7 days. And so this is a chart on the right here. This is from one of my market reports here a couple of months ago. This shows the fund position in the corn market. And if you look back to late May, June, these funds were nearly record short the corn market. And this is a good piece of information, because this tells me that if I am a farmer, I don't want to be selling corn when the funds are on the short side of the market. I would rather be rewarding the market when the funds are long. And you can look back over the last few years. At times, usually it's during the summer period, usually it's from spring to summer, when the funds are holding their biggest long positions of the year, and that's usually when we have our best marketing opportunities. It's no mystery that funds that buy the market, we get a weather rally, and like in 19, the red line here from May into June, July, gave us our best marketing opportunity of the year. So that's something that we want to continue to get that information out to the growers. I put these charts weekly in the market report so they can check that out and kind of see where the funds are at, because I think it matters, helps us to be able to make decisions. Right now, funds are holding near record length in the bean market. That's kind of a hint. Probably a good time to be selling beans, because ultimately they could probably go one direction, and that's to start selling those contracts that they're long off. And so that concerns me when the funds are holding a big position. The options market, options are a little bit like futures, except it's just an option. It doesn't mean you have to do it. You're buying the right, but not the obligation. That's what a call option. A call option is the right, but not the obligation to purchase the underlying futures contract. A call option is kind of like an option on a piece of land. You may have a piece of land, say 80 acres, and that a farmer may say, you know what, I would like to buy an option on that piece of ground to be able to buy that piece of ground at a certain price if I decide to do so between now and say a year from now. That would be a land option, but that's very similar to what a call option is on price on commodities. And then the farmer would have the right for a year to decide whether or not he wants to buy that piece of ground. If he doesn't, then the option just expires. And doesn't have any value at that point in time. And that's really exactly what a call option is. A put option, the people that buy a put option are buying the right to sell an underlying futures contract at a certain price. So it gets a little confusing on a put that you're buying the right to sell. But here's kind of a chart. Again, this is from my market screen, but this shows some of the ladder, if you want to call it that, the price ladder on options on December corn. And so on the left-hand side of the screen, I've got call options, and on the right-hand side of the screen, I have put options. Yesterday, if I had 4 cents that I wanted to spend on something, I could have done it on 2 different things. I could have bought a $4 call option for 3 7/8 cents, and that would give me the right to buy December corn at $4. Would I want to do that today? Of course not. Corn's trading at up here on the left-hand top left, 369 3/4. So I wouldn't want to buy corn at $4 today. But if something happens to where the market were to rally sharply in the next couple of months, say we get another crop report, and USDA lowers the corn yield 4 or 5 bushels, and the corn market rallies. And if that happens, then I might want to exercise my right to buy futures at $4 a bushel. It would have to rally 30 cents to get there, but nonetheless, so it's considered out of the money right now, but it's something that I could consider. The other thing on the other side is a put option. And this is what most farmers would probably be looking at right now, that if they have unsold grain for new crop, what is their risk? Their risk is that the market's going to go down during harvest. So we're sitting close to 370 today. I could buy a $3.50 put option for 4 cents. That would give me the right to sell December futures at 350. We had a low this spring, early summer, down in the 320s. What if, for whatever reason, the crop size gets bigger, the market goes down? What if it goes below 350? Buying this option for 4 cents would look really cheap relative to just sitting and watching the market go down and not having anything sold. So that's how a producer could use a put option generally for risk management. So the third type of tool is revenue insurance. Most of us don't really think of that. Yes, we know that prices are incorporated into our revenue policies, but I really look at some of these policies, especially the higher level policies, as a form of marketing. Because if you're buying a 95%, like the margin protection policy, we'll talk later on at some point about the ECO. We don't have the details about it, so I don't want to talk about it yet. But 85% RP policies or the 90% RPI policies, those higher level policies, you could have a drop in price and start to trigger some losses in revenue. And so that's why I really like to focus on the higher level policies. With 75% coverage, you're not getting much price protection. But once you get up to the higher levels, it doesn't take a lot of drop in the market to start to trigger losses. But I think there's really 3 reasons that producers buy crop insurance. Number 1 is to secure financing. Most of your banks are going to require you have crop insurance if you want to take out a loan. Number 2 is to provide a yield or revenue floor on their operation for the year. If I'm a producer, I want to make sure at the end of the year that I got at least X amount of money that's going to cover my expenses. It's going to cover my cost of living. I can do that with my crop insurance policy. And then the third thing is support for forward marketing. Probably not something that most of us think about, but we encourage people that once you're buying that policy that's giving you a bushel or a yield guarantee, to go ahead and utilize that guarantee to market. And that's part of the reason that we have the upside protection in our policy, that if we're wrong and we have a drought, the market goes up and I have to buy back some sales, then I'm going to get paid at the higher fall price. So that's one of the benefits of this policy, and we'll hit on that here in just a second. So 2 out of the 3 really have to do with marketing or doing something to lock in price. And when I talk about revenue insurance, I talk about revenue insurance really being a series of 3 different options. You have a put option on yield. Now, most of us don't think about our yield guarantee as a put option, but essentially that's what it is. If my APH on my corn this year is 200 bushel an acre and I buy an 85% policy, that means I've got 170 bushel trigger, or that's my strike price on my yield put in my policy. If my yield drops below 170, I'm going to start to get paid something for that loss. I have a put option on price. We talk about in margin protection insurance. I've been writing about this lately, but a year ago we had the margin protection price set at 403, and you had December futures go down into the 320s this spring, and we were really looking at margin protection having some large payments this year because of the drop in the price. Even if the yield was up a little bit, that drop in price was really going to start to trigger some losses. So now that prices come back up, it may not be as much, but the producer still has that put option in his policy. If the price drops between now and the end of October, it would trigger a bigger loss and a bigger indemnity payment. And then we have the call option on price. That's the upside, the harvest price option that's built into the policy. If we start out at $4 corn in the spring, what happens if we have a drought? Like in 2012, the market goes way up. That's a call option. If essentially the same as a call option, and we get paid on our lost bushels at the higher fall price. So that call option, or that option within our policy, is essentially a call option. We have the opportunity to buy different other tools like Easy Rev or R Powered that are essentially call options that allow you to add other months to your policy. These price flex type programs are essentially call options that you would add to your insurance policy. So how does it work? Well, I've talked a lot about the price put option in your policy. And here was a chart of December corn. This is back from July the 20th. But I was showing basically all of the different lines on here of how different policies would start to pay, making the assumption, of course, that our yields were average. But if we raised an average yield for the county or say I match my APH on my farm, then on the margin protection insurance policy from last year, we had a base price at 403. But I've showed that 5% loss, 10% loss, 15, 20% losses here in the dark green lines. And at one point, we had traded futures down to a 20% loss in price. Margin protection at 95% would have been looking at a 15% difference then, and possibly seen some very large payments. Now that the markets have come back up into the 360s, still might see some losses because we've had over a 5% drop in price, and it depends on the county yields as well. For RP insurance, we had a base price at 388, and there was a time where and if you had SCO on top of your policy, that was up at 86%. We spent a long time below that 86% level, or a 14% drop in price. So with average yields, our policies were in the money at that point in time. And even the 85% policy when we traded down in June. Today, that may not be the case, but it still depends on your yields. But this is why a lot of people were maybe not fretting so much as we got into May, June, and July, that we knew that we had this revenue policy that was backing us up. We didn't know what yields were going to be like yet, but we did feel secure, at least knowing that we had a revenue policy that was at least going to protect us if the price kept going down. So when COVID hit, when we weren't not sure about acres, we weren't sure about yields, we were talking about 30-year highs in corn stocks at the end of the year. Those of us that bought the higher level insurance policies felt a little bit better about the crop that we had. So Steve asked the question, what is your recommendation when purchasing MP as a put, MP versus MP HPO? It's a good question. I know it's been debated a lot. I like using the, I understand that the question is, if I just bought the MP without the harvest price option, saved some money, and then bought RP insurance later on in the spring that does have the upside. Probably depends a little bit on my relationship with the county. You could do it that way, just by the HP or the HPE on the margin protection, just have the downside on price, and then have the revenue policy in the spring. Or you could do the margin protection with the harvest price, and then maybe just buy a yield policy in the spring. There's two different schools of thought on that. Both of them trying to save a little bit of premium money. I would tend to lean towards, if my yields historically were better than the county year in and year out, then I would probably want to have my upside price on the margin protection and maybe just do yield only on my farm. If I was a little unsure my relationship to the county, but I still like margin protection policy, then maybe I buy it without the harvest price and then buy the harvest price on my individual crop. And it probably depends then too how aggressive of a forward marketer you are. The more aggressive you are as a seller, if I'm going to do something like that, then I would want to probably have the harvest price on my my individual policy. But I know that's been debated. I personally don't like HPEs, harvest price exclusions, because you could have a situation where the price went up and then your yield trigger goes down. So if I were to do it, I would just buy yield only and not do the harvest price exclusion. And if I were going to do yield only, then I would have to do that on my farm and then do the margin protection for the county. But that goes into a discussion for a later day, and we can talk about that at some point in time. The seasonal tendencies of the market. So we've talked about some of that a minute ago. Watts put this out showing how some of their intervals happen to match up with the seasonal tendencies. Here's a timeline of corn futures over a 23-year window. And it really shows that the year previous to the crop year, that summer window is really when we tend to set the highs. Then again that following summer, then again the next summer afterwards. So we know that May, June, July period tends to be our best marketing opportunities. We can utilize a lot of these products, the R-Powered, the Easy Rev, to be able to take advantage and be able to add a few pennies to our policies doing that as well. Doesn't happen every year, but year in, year out, those tend to be the averages. I've talked a little bit lately, and if you read the Revenue IQ letters that I put out, we talk in there about utilizing margin protection because we've set those prices right now. Those are already locked in as a way to essentially have some downside price protection for next year. And one thing I urge producers, if you're going to plan on planting a crop next year, and if you're not doing any forward selling or anything to market or to manage that price risk for next year, then margin protection insurance is one way you can go ahead and do that. And right now that would use a $3.82 price on corn. For this year, it would use a $9.36 price on soybeans if you wanted to utilize that policy for 2021. I mentioned the R-Powered and the M-Powered, and this week alone, I had a little blurb in my market report a couple of days ago. Watts put out a power play talking about the bean market. Now's the time to maybe utilize the R-Powered or the M-Powered product to lock in a price for 21. If I was going to just buy revenue insurance only, the RP policy, I can lock in essentially a minimum today. And if you'd have done this on Monday, we could have locked in, I think the bean price was up around $9.76. The corn price would have been at $3.93, I believe, that you could have locked in on Monday for next year. That would have been the worst case scenario for you. If your average in February was higher than $3.93 on corn, then you would have that price in your policy. If it was not above $3.93, then you would get to use that to calculate your insurance trigger for next year. So that's why today we can utilize this program. For M-Powered, even though those prices were already locked in, I mentioned on here that with the price on Monday, you could have added $22 an acre on corn, possibly up to $60 or $24 an acre on soybeans by having the prices above those MP base prices. Corn was at $3.93 compared to $2.82. Beans were up into the $9.80s, I believe, but even $9.76 at the close compared to $9.36. So you'd have had the opportunity to add 40 cents a bushel that day to your base price for margin protection. So, and it would have cost you less than half of that to be able to add that. So something to at least consider. It's kind of water under the bridge right now, but if you understand the R-Powered and the M-Powered products and everything that's involved with those products, essentially you're utilizing those products as options. It's kind of like setting a put option. It's locking in a floor on price for your insurance policy. So how can we utilize our footprint in commodity marketing to help our farmers? That's the gist of this call. Help them be more profitable. We've got a series of different marketing services that we provide. And I give kudos to our IT group at NAU Country. That's been a phenomenal start in getting all these things up and going this year and getting producers signed up to be able to utilize these products. The opening bell is a phone call that I put out every morning. I record it at 8:35 and it comes out about 8:37 or 8. I wait until the market opens at 8:30 and then we blast out the phone call. And if you've got your producers that you want to receive this, send me the note. We can get them added just send me an email. We can get them added to the list to go out. As agents, you can utilize this service as well. If you're interested in being able to use this automatic messaging interface, we call it AMI, it's automatic messaging interface. If you want to use this to put out a phone blast to your producers, we can set up a list in here. You can dial the phone number, record your message, hit the send button, and it'll send a blast out to all of your clients. So if you've got 100 customers, it's a great way to be able to put out an announcement that maybe tomorrow is acreage reporting deadline. I need to get all your stuff in by tomorrow. Maybe we're going to have a meeting next week and you want to send a blast out to everybody. It's a great way to be able to do that in one simple call. So if you're interested, let me know. We can help you get set up. The market report letter is an email letter that comes out every night. And here's what it looks like. Comes via Constant Contact. And this was a couple of days ago's letter, but I had the latest revenue IQ on margin protection on there. I've got my daily market report letter here in the blue, and I've got some other articles attached as well. We've got a lot of new information coming out about the CFAP 2 program. I've tried to send that out as well, but this is what it looks like when it comes. If you open up the letter, this is what the letter looks like. I've usually got charts in here with some information about the market, some things that we're looking at, maybe some buy, sell opportunities, weather, you name it, crop insurance, updated prices. I keep that all in this letter each day. If you've got producers you want to get this directly, send it to us or send it to our IT marketing email address. We can get them added to the list to be able to receive this directly every afternoon. And here's a sheet that we've got that we can use for meetings. If you're interested or you want to keep a stack of these in your office to hand to producers when they come in the door, if they want to sign up for the opening bell or the market report, they can give you their information, click the box that they're interested in. You can send this back to us, take a picture of it, email it to us, whatever, and we can get your producers set up to be able to receive the information. So this is, as far as I know, going forward, we're probably going to be the only AIP that's doing this. But we're not only wanting to help our customers be able to pick the right information, we also want to help them be successful on the marketing side. These are two different ways we can get them that information. The Aftermath is a webinar that we do each month. It's at 9 o'clock in the morning, the day following USDA's crop report. We talk about the aftermath of the USDA report that day, what they did to the market, what the numbers read, what we think going forward, maybe some ideas on how we can market, how we can maybe use a put and call spread, something like that, different marketing strategies in order to be able to set some floors and maybe give some upside. So just try to share ideas. I'll talk about insurance pricing. We'll talk about the FSA programs, where the PLC and ARC programs look as of that point in time. So I would encourage you to be able to utilize that service. We have agents that utilize it, show it live in their office, and have producers come in and sit down for coffee and donuts. And they'll watch it, and then they'll talk about it afterwards. I've had agents tell me that they've set up marketing groups of half a dozen farmers that come in every month, and that's their marketing group. They like to sit down and talk about their strategies and what they want to do for marketing their grain. If you miss it live, we do record it. We post all of those out on our YouTube channel. So you can go through the agent portal to get there and be able to get all of this information. A podcast I record called Kicking Up Dust. It's on Podbean. If you miss that, or if you want to subscribe to Podbean, you can on Podbean. You can listen to those as they come out. I record these probably about every other week. If you miss those, go to the agent portal and you can click on all of those. Those are all housed out there. This is what it looks like on Podbean. This is a snapshot of my screen, so you can see the ones that I've recorded. And by the way, all of this information is available in the agent portal and on our app. If you have the NAU Country app on our phone, you can get every piece of marketing information that I put out. You can get the daily market call, the opening bell call. You can get the market report email letter. You can listen to the podcast. You can watch the Aftermath webinars. All of that is housed, and you can get to it via the link through our app on your phone. So it's pretty phenomenal that all that's at your fingertips if you want it. Same for your producers. Crop Scout Insights is a letter that we would send out bi-weekly during the growing season with an update on the crops, what's going on around the country. And I had about 35 agents and or other folks that agreed this year, thankfully, to share comments about crops in their states and their areas. Some sent pictures. I would send right the front page with the update on what the crop progress numbers did from that week, and then we would get highlights from each state. So phenomenal service. I enjoyed reading what was going on in 30 some other states and being able to see what the crops were doing around the country without having to get the car. So great opportunity to be able to update and see what the crops look like. Revenue Perspectives is a letter that you can use. And I write the inside of this market letter usually on the day of or the day after the USDA report. And you can see here on the right-hand side, I've got some of the balance sheets for corn, soybeans, and wheat in this case, showing what the changes were that USDA had in the July crop report. I've got the updated government program payment prices, the market year average prices, and what the impact is potentially on PLC and ARC payments. So I write the inside of this letter. The outside of this letter is for you. And we post this and make it available to you. I do write put some calendar dates in here on the left side. If you don't want to use that, you can put in whatever you want in this box on the left-hand side. You can put in your agency address. You can put in your agency logo on here. You can print these, send them out to your customers. You can email them to your customers. But it's a way that we provide some content for you to be able to send to your people. So I've liked to use this over the years because I know everybody doesn't look at email every day. But this is a way that you could send something in the mail. It's a tri-fold. It's meant to fold in 3 parts, and your growers are going to get something from you. You can prospect with this. Send it to new people that you don't do business with. So it's a neat tool to be able to use, just another tool in your box to be able to reach new people. I also speak at a lot of farmer meetings throughout the year, particularly in the winter time. So I'm willing to go do that as well. And I do tweet every morning. So my Twitter handle is Rich Market Guy. If you follow social media and you're not following me, give me a follow, as well as NAU Country's Twitter account as well. But I like to send something out, usually not as early as President Trump, but usually about 7:30 or so in the morning with what the overnight markets did and kind of why they did what they did. So if you follow Twitter, the bottom line is we use provide a lot of different information to help you, help your growers try to be profitable. I had to show one last thing, and this was a text that I had gotten from an agent, and I was kind of flattered by it, but it does show that some of what we do does make a difference. And this agent sent me this. He said, with the change, and this is back in January, right after I had come to NAU. The producer asked where I was at. He said, with NAU Country, and he said, you write with them? He said, yes, we do. And he said, okay, if that's where Rich is, that's where we want to be as well. He's made me just as much money as you guys have, and I can't afford not to have his insights. So the bottom line is the stuff that I provide doesn't cost you, the agent, doesn't cost the farmer anything. We're trying to help them be successful. And if we can do anything to try that can help them make money or can help them not lose money, that's our goal. And we've got a lot of different means to be able to try to get that done with these different tools. So with that, I thank everybody for joining me this morning on today's NAU Country Connection webinar. If you haven't registered for future Connection webinars, please do so. We've got a variety of different topics that we're going to cover throughout the month of October. If you've got ideas for other topics, please send them to itmarketing@naUcountry.com, and we'll be glad to entertain those and see if we can work those into the schedule. So with that, I don't see any other questions. So if you do have questions, feel free to shoot me an email at rich.morrison@naUcountry.com, and I'll be glad to answer those. So with that, I thank you for joining and hope you have a great rest of your week.